Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, January 31st, 2025. Wow, the month of the year has already flown by, man. What an eventful month and an eventful year already. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will tariffs tank the U.S. economy? Our answers are probably not. After all, there are 6 pillars currently upholding the resilient U.S. economy theme we authored in the summer of 2022, which persists. Trade does not constitute a large enough share of U.S. GDP to upend any of those dynamics. Therefore, the resilience of the U.S. economy is likely to persist. Moreover, our industry-leading empirical deep dive of U.S. business cycle dynamics continues to signal a low probability of a developing recession over a medium-term time horizon. That's the good news. The bad news is that tariffs are indeed coming, as evidenced by President Trump confirming the February 1st start date for 25% tariffs on imports from Canada and Mexico, the U.S.'s two largest trading partners. Officials from both economies hinted retaliation is likely. All told, investors should expect U.S. growth to continue slowing over the medium term amid elevated policy uncertainty, steepening base effects, slowing labor supply growth, and a likely reduction in federal expenditures. Consensus expects growth to slow, so the direction of travel is unlikely to be a headwind for asset markets. What may emerge as a headwind is persistent negative economic surprises. Recall that GDP has been outperforming consensus estimates since we authored the resilient U.S. economy theme in the summer of 2022. Our grid model is now calling for growth to be reported in line or slightly below consensus over the next few quarters. That dynamic is new and may support the bond market and, by extension, risk asset valuations. That is, until the 5 interconnected hawkish catalysts we identified begin to materialize this summer. Refer to our January 18th Around the Horn presentation for more details. Transitioning to our 42 macro dashboard here. As always, we'll wrap up the question from our community. This one's regarding TGA depletion and equal weight exposure. It says, hi, Darius. Hope you're well. I have 2 questions. I see the TGA account has been rebuilt up to $811 billion as of yesterday. Is the expectation still that this account will be taken close to zero amid an impasse between Republicans and Democrats, which may help assist valuation multiples to re-rate even further as a primary contributor to total return? So before I move on to the second question, because it's different, I'll unpack the answer to this one first. So our expectation is that they will draw down the TGA because it's unlikely that even just congressional Republicans can agree on, what the ultimate contours of extending and expanding the Trump tax cuts is likely to look like, what the federal expenditure reductions offsets are likely to be, what tariff policy is likely to look like. It's getting messy. I mean, I pay more attention to DC politics than I ever have in my career and probably want to. But the reality is there are a lot of competing factions within the Republican Party itself as it relates to crafting legislation to satisfy all those presidential agenda items. When you think about so you don't even need the Democrat. What I'm trying to say is you don't even need the Democrats. I mean, the Republicans can't even agree on whether or not it's going to be 1 reconciliation bill or 2 reconciliation bills. And President Trump's been in office for 2 weeks. And more importantly, the Republicans have known that they've controlled both the White House and Congress since early to mid-November. And so, in my opinion, I just think that this is this process is ultimately we know what we're going to get by the end of the rainbow. It's just that the width of the rainbow is probably going to be a bit longer. So what that ultimately means is that the extraordinary measures that the Treasury Department have put in place currently, which are delaying the TGA spin down that we've been forecasting since early September, it's been delaying that. But the mere fact that we have hit the debt ceiling and are not issuing net new debt is a positive catalyst for asset markets to begin with. If coupon supply is a negative catalyst, certainly increasing coupon supply, then obviously removing supply altogether is a positive catalyst because ultimately it creates a scarcity amongst the remaining assets, most of which are risk assets. Don't forget that the U.S. Treasury is at the top of the global capital structure. So these things are positive. I would imagine it's had some influence on stopping the ascent in bond yields, over the past few weeks. So that's been supportive of risk asset valuations as well. So all told, we expect the TGA to be spent down. The fact that they've as a function of infighting between congressional Republicans, let alone Democrats, but the mere fact that they sort of decided to sort of authorize the extraordinary measures, quote unquote, before the TGA spin down ultimately means we're probably not going to see the magnitude of TGA spin down that we were originally projecting. However, it doesn't matter. I mean, again, you're talking about the debt ceiling being breached and no net new treasury supply. That is bullish. So just be aware of that. Number two, is it worth rather expressing the U.S. exceptionalism theme through equal weighted S&P 500 exposure as opposed to just the S&P 500, given that some benefits may be broad based, i.e., tax cuts? This will potentially avoid idiosyncrasies in the tech sector, for example. Yeah, I mean, I think that's a fantastic idea, and I think if you're not having that debate internally or amongst your investment committee after the DeepSeek news over the past week or so, then you're no offense, you're probably asleep at the wheel. You need to be having that conversation as an investor. So this is me telling you to have that conversation because ultimately, we may be shifting from a phase where the market is rewarding AI enablers from a picks and shovels perspective as it relates to the NVIDIAs of the world and ASMLs and what was the other AMDs, all these other sort of chip manufacturers. They could be transitioning the capital at the margins to the AI adopters and folks who sort of help AI get adopted amongst enterprises and consumers. So this is all positive for the AI story, by the way, because ultimately what DeepSeek is doing is forcing AI to be cheaper, better, faster, and ultimately in the hands of consumers and enterprises much faster than it probably otherwise would have gotten there. And so, the AI theme is certainly not dead. If anything, it might have gotten fortified by the DeepSeek news. But what it ultimately means is that there is going to be a transfer of relative performance from the NVIDIAs of the world to places like Meta or even companies that are building applications for consumers and enterprises. Apple could be one of those types of names. And so ultimately, this AI theme is not going to work long term unless companies like myself, like my company or your company, or your doesn't show up on one of these things, it needs to get out into the broader economy. And so ultimately, from maybe not today's starting point, but at some point in the future, you have to expect a significant and sustained outperformance of the equal weight S&P 500 relative to the broad, cap weighted index, which is obviously heavily tilted to the Mag 7 names. And for the record, I'm not making a call on that right now because I don't know if we know enough yet to make that call. But ultimately, and by the way, growth is slowing, so you're probably not going to have AI being adopted by these companies is not the only thing that matters to their their earnings and their revenue and their cash flow generation. So be aware of that. This is one theme of the broad many themes. And so this may not be a perfect time to rotate just in terms of where we are in the growth cycle, potentially where we are with the elevated policy uncertainty, which is weighing on the growth cycle. We can talk about that. We talked about that in the last couple of lead-off morning notes. So at the end of the day, yes, equal weight will outperform the S&P 500 at some point, but it could come in a bear market, by the way. We saw that occur in 2000 and 2003 within tech bust. You actually had dramatic outperformance of equal weight and Russell 2000 and these sort of kind of quote real economy type stocks relative to the digital economy stocks in the name of the previous tech theme. And so, so not tech theme, previous internet theme. So that's a long-winded way of saying yes, the trade will eventually work, but I'm not so sure that this is the appropriate time. We're probably a little bit too early to go full-blown equal weight over cap weight or something else, just in the context of where we are in the growth cycle. So we'll wrap it up there. We're going a little long today, but two very, very good questions. So I just want to make sure investors are aware of our latest thoughts on these topics. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.